The mutual fund industry is going from strength to strength. The average assets under management or AUM of the mutual fund industry crossed 38 lakh crore rupees as at end November. That represents a 29% growth in assets year on year. The underlying trends are all the more positive. Net inflows into the equity schemes has been positive in the past 9 months. Not only has it enabled equity markets to scale new heights, but is also supporting the markets amid the large outflows from foreign portfolio investors or FPIs in the past couple of months. Among other trends, the rise in flows through systematic investment plans or SIPs is very encouraging. Notwithstanding the ebbs and flows in aggregate mobilization by mutual funds, SIP continues to remain favored amongst retail investors. The SIP flows has hit an all-time high of 11,005 crore rupees in November. The cumulative assets garnered through the SIP route stood at 5,46,683 crore rupees, equivalent to around 44% of the industry's equity AUM as of November end. Today, mutual funds have become a mainstream investment vehicle with households increasingly favoring mutual funds to bank deposits, which hitherto were the most preferred vehicle for parking savings. The enduring popularity of mutual funds is reflected by the rising number of new investor accounts known as folios as per mutual fund parlance. There were around 11.16 crore accounts in the mutual fund industry as at September end, of which around 91% is accounted for by retail investors. The SIP folio stood at 4.78 crore as at end November. Steady growth in folios over the years has led to retailization of the mutual fund industry, with individual investors leading in terms of AUM contribution. Individual investors hold a higher share of industry assets, 55% in November 2021, rising from 52% in November 2020. The rising participation of individual investors is positive as flows from individual customers are relatively sticky and steady. Also, individual investors prefer investing in equity schemes that generate higher investment management fees compared to debt schemes favored by institutional investors. Overall, FY22 so far has turned out to be a spectacular year for the mutual fund industry. However, the stock prices of the listed AMCs have seen a steep fall in the past 3 months. The resultant dip in the valuation of the AMC stocks is in contrast to favorable industry trends and presents an investment opportunity. Last week, HSBC Mutual acquired L&T Mutual Fund for a total consideration $425 million, which translates to 3,200 crore rupees. Adding cash of 550 crore rupees on the books of L&T Mutual Fund, which the holding company will retain, the total consideration works out to be around 3,800 crore rupees. The deal seems to be priced on the lower side compared to listed peers, especially given the fact that equity assets constitute around 43% of L&T Mutual Fund's total AUM as at end September, in line with the industry average. HDFC AMC's asset growth has lagged the industry's assets growth in the past 1 year. Consequently, HDFC AMC has lost market share in terms of overall AUM. This is reflected in the stock price that has massively underperformed the broader benchmark or Nifty and most listed players. Even after the correction, HDFC AMC is trading at rich valuations of 11% of its trailing AUM, which is Q2 FY22 AUM and 32 times FY23 estimated earnings. On a relative basis also, HDFC AMC is being valued at more than 50% premium to its closest listed peer. While the premium valuation may sustain, given return on equity or return on investment of around 30% and HDFC AMC's favorable asset mix with leading position in equity business, near-term upside to the stock price looks limited as HDFC AMC continues to lose market share. Nippon Life has already corrected 29% from its 52-week high price. Investors can keep the stock on their radar and accumulate it on further fall. Since its listing in the first week of October, Aditya Birla AMC has seen a steep fall of around 28% from the issue price of 712 rupees. Being the fourth largest AMC on the basis of total assets managed as of September end, it will continue to be one of the key beneficiaries of the enduring growth in the mutual fund industry. The sharp fall presents a good tactical opportunity to buy the stock. UTI Asset Management is the cheapest stock in the AMC space, and the reason for the same is lower share of equity assets in the total AUM. However, UTI has improved market share and has seen a strong growth in equity assets in the past 1 year. No doubt the stock has outperformed the listed peers. The stock has moved up by 61% after we suggested it as the best bet on improving domestic flows in May. We reiterated our positive stance by again recommending UTI AMC as weekly tactical pick in June, and the stock has gained 25% since then. Despite the outperformance, valuation is still attractive at 18 times FY23 estimated earnings, considering the fact that ROE or return on equity has improved from 10% in FY20 to 15% in FY21 and further to 22% in H1 FY22. Moreover, UTI AMC's valuation is at a significant discount to both HDFC AMC and Nippon Life. We expect the valuation gap to narrow down, leading to further upside in the stock price. Overall, investors can look to play positive undercurrents in the mutual fund industry by buying the stocks of Aditya Birla AMC and UTI AMC.